We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Brady, former money manager, Sprott Money contributor, advisor to 4779 Capital, and author of the FIPES Report Substack. David, thanks for joining me today. How are you?
Oh, great. I love talking to you, Tom. Let's get this going.
Absolutely. I feel like the intro is starting to get longer and longer, and we can, well, in a way that's good because we can get more exposure to your ideas and your writing. And I appreciate getting to sit down with you today to get some of your perspective. But I thought we could kind of start by, you shedding light on some of how you see the current run above $2,000 in gold and how it fits into, let's say, the Elliott Waves as you're seeing it.
Well, first of all, the obvious answer is we've broken out to a new record high. So we're in a bull market. What people struggle with is they expect, we hit 2152. That is just going to keep going up higher. Markets work in zigzags. Now, when you're in a bull market, those zigzags trend overall up, higher lows, higher highs. And by contrast, when you're in a bear market, it does the exact opposite, lower highs and lower lows. Well, obviously, we have higher highs and higher lows, so we're in a bull market. But at 2152, when the banks are significantly short, sentiment is not bullish, it's euphoric. Technicals are extreme overbought. That's a time to take a pause and say, hey, we need a correction here. And that's what I said on December 13. I called it the perfect storm. And that's what we're going through right now. We're going through a correction. I believe that we've had what I call the ABC correction. And we've had the wave A down to 1988 in gold. Now we're in wave B. Now it may have peaked. I doubt it, but we may have peaked. But I have no confirmation that it has. But once we get the peak in B, then we'll have a good idea of where C is. And I just wrote an article today for Sprott Money where I said, here's some suggestions if we peak at 2063, if we peak at 2100 in wave B, this is what I think wave C will turn out to be. But one thing I have confidence in is that the next low will be lower than 1988. So I don't know exactly what that number is. Mm-hmm. It could be 1933, it could be 1900, it could be in the 1800s. But we're going down to a lower low, in my opinion. Now, at that point, and I don't want to belabor it because I've talked about this, to death. At that point, at that low, you'll know most retail traders will throw in the towel. They'll be just fed up. A minute ago, we were at 2152, and now here we are at 1900. What's the point? Mm-hmm. The same old same. I'll be loading up for what happens next. Because this is an ABC correction. The zigzag's down, but it has to fall below 1824 to negate the uptrend. It hasn't, and it won't, in my opinion. So when we get down to those low levels, it's a gift. And I plan to go all in on those. I'll be using high beta miners. I'll be going full leveraged because what I believe is we're going to go up to another peak that exceeds 2152. It may even just be 2200, but from 1900 to 2200, especially if you're leveraged, you're going to do pretty well. So to answer your question, we're in the correction. We're waiting for the bottom, waiting for the wave B top, then the wave C bottom, and then up we go.
I think an important point to really highlight at this time, especially going into Christmas here, is the idea that, the markets at this point are traded so thinly right now. So why do the bullion banks love that time? And how does that fit into your analysis, like you said on December 3rd, that you were able to see how all of these things were going to play out?
So on December 3rd, we didn't have thin markets, and look what happened. The 6th biggest decline in gold on an intraday basis in history. Now we are in thin markets, and guess what? They have a higher short position, at least as of Tuesday last, than on December 3rd. And we're going into the holiday period where traders are taking off for vacation to January and so forth. If I were long, I would be scared right now, because the bullion banks are significantly short in a thin market, which means it requires very little capital on their part to drive the market lower. Mm-hmm. They will trigger stops. I saw somebody say on Twitter, oh, there's a short squeeze coming. Yeah, there's a squeeze coming, but it's not going to be the short squeeze. It's going to be a long squeeze. And that'll generate the lower low that I just mentioned in gold and in silver. The percentage loss in silver will be greater than in gold, as it always is. It has a beta of about 1.5 to gold. So to answer your question, yeah, I think it's going lower. And the bullion banks have been so active for weeks to suppress the rise in gold. But as I've termed it many times, it's an organized retreat. And how do I validate that? We keep hitting higher highs. Mm-hmm. So what they were doing is we go up, everybody gets bullish, and they hammer it back down. Then it goes up again, and it goes into a higher high. Then they hammer it back down. And it's just going to continue. They don't want gold going through the stratosphere. They will let gold go, and silver, when they choose. They're not going to let the market take it. They have to be in complete control like everybody else these days, it seems. And but gold is in a bull market. We're going to go to new higher highs, but we've got to wait for this low to come. And the thin markets that you mentioned makes it so easy for the bullion banks. If they choose to do it, nothing is certain, but the conditions are perfect. They've loaded up short. Markets are thin, and here's the deal: they've loaded up short at 2152. It fell from 2152 to 1993, I think, and they just cut 9K contracts. Just 9. After that big drop, typically they use those drops to cover their shorts, make massive profits. They barely cut them. And then the market went back up gold went back up to 2050, 2060 right now. So they probably added even more shorts. What does that tell you? They're getting ready to hit this. If they thought it was going to go up, they would have covered. They didn't. They're adding. Mm-hmm. So I say get the hell out of the way and wait for the bottom. Stop playing in between the major levels. I'm a swing trader. People say you can't pick peaks and troughs. I disagree. It depends on your process. When you're in the middle, in no man's land, as I like to call it, that's just plain guesswork. It's coin toss. But when you get to extremes in sentiment, in technicals, when it matches what the Elliott Waves are saying, when the positioning tells you what's going on, when Dixie is in the toilet and the yields are in the toilet, what typically is going to happen? The exact opposite. I expect the Dixie to rebound here shortly. I expect yields to rebound shortly. And that'll provide cover for the bullion banks to hammer gold and silver again. And then the whole point is to squeeze. I've said this many times. The whole point of these corrections, especially when the bullion banks are involved, is to push as many people out of the market before it goes up, because they don't want you getting rich. Mm-hmm. They don't want you making money. They want to make all the money. And once you figure that out, it's got to the point where when it gets hammered, you sit there and wait to buy. When it goes stratospheric to the north, now It's harder with gold on this one because it can go parabolic. But most of the time, the vast majority of the time, you sell. And that's all I've been doing since 2015. When it gets down to a low, I buy. When it goes up to a high, I sell. Sell high, buy low. That's a new concept. But, but in doing so, you're fighting human nature. And I've said, and we've talked about this before, Tom, emotion is the death of wealth. And people let their emotions take over, and they do the exact opposite. They sell at the low and they buy at the high. And the bullion banks know this. Mm-hmm. So this is why they operate the way they do. And I'm not saying it's a certainty, but the conditions are perfect for them. So it's a warning. But I'll be loading up when we get to the ball.
Mm-hmm. Of course, you mentioned your process, and of course, it's called the FIPES process. So we already talked about sentiment, and I think you pointed out a really interesting example of that, how it works when, let's say, the biggest bear on the stock market, Mike Wilson, says equities have gotten a green light to ramp higher, right? So
yeah,
how do you view that, and how does that play into your thinking when even somebody that's always bearish reverses his stance?
Well, it's not just him, Tom. I mean, Michael Hartnett has been a fantastic trader. He's a prognosticator. And I wrote a tweet there about a month or two ago when he rolled out something. I think I can't remember whether it was up or down, but it was the exact opposite of what I was thinking. And my tweet was something along the lines of, now they're taking the great traders, they're sending them out to say, oh, it's going down, when everything else says it's going up. And what happens? It goes up. Because these guys are bankers and they have bosses, and they're trying to sell a narrative, a story. So who better to do to sell that story than somebody who's been right quite often? Now with Wilson, it's a little easier, And so the day when he came out, oh, I'm changing my tune. Well, and I said it in the tweet. You've been wrong the whole way up. And now you're saying, oh, it's going to ramp higher. Sell. And I equate that to the Jim Cramer CNBC indicators. Mm-hmm. They are like headlines. I've often said, is this the kiss of death in response? Because they typically come out when the market is extended and they say, oh, it's going to go higher. That to me is a warning sign, like, get the hell out. Because everything the establishment does is to make themselves richer. Mm-hmm. They're already rich, but they're greedy. They want more, and to impoverish everyone else. And once you figure that out, it starts to make sense. And so for me, I don't know if Wilson was going to be right or wrong the next day, but my spidey sense said this is going down. And I just threw it out there, watch this. And sure enough, the next day, down it went. And I will say this, with the FIPES process, because I rely on data, those signals are anecdotal to that data. And the data to me, as I warned, like I was a bit early, it was December 11, I warned that the S&P is coming to a peak here. And to me, this isn't rocket science. You're heading up to the all-time high of 4,800. Do you honestly think it's going to go straight through on the first attempt? No. Look at what happened to gold. You know how many times we went up to 2085, 2090? Mm-hmm. Only on the 5th did we get through. So don't expect anything. It's a magnet for sure, but it's not going to go through on the first attempt. So, and now we got the pullback. And I think that I don't know whether this is just a mini ABC of the A, because it's an ABC correction again, or it's the big A. But if it's the big A, then we only go down to 4,600-ish. And then we go up to break a new high. Mm-hmm. But here's the thing I want to say, Tom. A lot of people, when I say these things, they say, oh, you're always bearish, you're always bearish. No, I think the S&P is going over 5,000. I'm just telling you what I'm seeing. I like baby steps. I have no time for people, especially the ones that go, 20 years from now, the Dow is going to be at 100,000. Yeah. It's like, I was going to say a political comment relative to Canada. I'll avoid it. when they make these forecasts about certain things 10 years, it means nothing. Nothing. I'd rather stick to the baby steps. I've got a big picture in my mind, but I'll focus on what happens next. Mm-hmm. Not what happens a year from now or whatever, blah, blah, blah. I know the overall picture for gold is much higher, silver even more so. But in the short term, of course, you get pullbacks. We go back to the zigzags I brought up earlier in answer to your question. You have to absorb this and get religion about it. Don't dismiss it, because it just keeps happening. The definition of insanity is, well, there's a few of them, but doing the same thing over and over and expecting a different result. Well, if you're doing something wrong and you're constantly losing money, try the opposite. So learn from your mistakes. I'll leave it there. I could ramble on all day.
Well, I think that's something that we get into trouble with a lot is misunderstanding the timelines that we're talking about. Whether it's manipulation or it's gold going up, whatever it is, if we're not understanding the exact timing of what we're trying to consider, I think that gets lost a lot on Twitter in these conversations, because I think that's where a big part of that misunderstanding comes from.
Absolutely. But, the most difficult task is finding, there's a lot of amateur traders out there or new to this, and they know something's wrong with the system. They want to protect themselves. And then there's the ones that are basically gamblers. But they're new to this. The challenge is finding analysts that you can rely on, not to tell you exactly where things are going, but are more or less right most of the time. They never always be right. And unfortunately, in this business, there's a lot of charlatans, there's a lot of cheerleaders. The way I would go about it is, yes, try and find consistency. Forget the guys who are popular, that know how to say the right things, they're articulate, they're polished, they sound smart. That doesn't mean anything. Do they get it right? And how often? Mm-hmm. And the other thing I would say to look for is people who make calls in both directions. In other words, in a screaming bull market, they can say it's going down. I'll give you one example. A guy I really like, I don't subscribe to his channel, but whenever I see him publish something publicly, I like how he writes. And I think we think very similarly. So it's a bit jingoistic on my part. But Gary Savage is a very good trader and very good analyst. Mm-hmm. Excellent. So, and there are a few others that I watch too, but he's one of the best. Because he, like me, he considers all tools. He adds the cycle piece, which I don't use, but I listen to him about it. But he calls the market in both directions, and he doesn't do it whimsically. He's very I won't say adamant, but he's very confident in what he's saying. Now, he gets it wrong. I get it wrong too, and we're never going to hit the nail on the head. But those are the kind of analysts that you want to follow. Not the ones that constantly tell you, oh, now we're going up. Okay, yeah, we just fell $300. Now we're going up. Thanks, that's great. If they're consistently wrong or consistently talking in the same direction, just trash bin. Mm-hmm. And then learn from them. What are they doing? What they're saying? So, like, for instance, I don't know what Gary's saying, but I do know what I'm saying. And in my articles that I provide to Sprott Money and now my Substack, I lay out in detail how I come up with it. I don't just say, hey, gold's going to go down to 1950, 1900, and then I'm going all in for 2200, maybe 2300 next. See ya. No, I give all the detail, and it's data. It's not opinion. Here's why. And I got criticized by a very well-known person. You always caveat, in my humble opinion. We already know that. Yeah, but I like to say it because it's true. And secondly, I don't want somebody coming back, you told me this. But it is opinion, but it's based on data. data, a process that was developed looking back 20 years at all the peaks and troughs, looking at consistent patterns across those peaks and troughs for every asset you can think of on the futures market, and using 6 multiple tools. It's not rocket science. Anybody can do what I'm doing. They just don't put the time in. I'm serious. What I'm doing is not rocket science. It's easy. And it doesn't mean I'm going to be right all the time. Mm-hmm. But if you go back and you look at every peak and trough, and you look at the RSIs, and you look at the MACDs on a daily and on the weekly, and even maybe the monthly, and then you look at sentiment, and then you look at positioning, and then you look at what the Elliott Waves said, and then you look at what the fundamentals were. When you look back, retrospection is 2020. But the beauty of it is you can extrapolate it forward. Mm-hmm. Anyway, I'll stop there. But that's what I recommend people do. If you can learn it, it's getting late in the day, so just find a couple of good analysts and stick with them. Stop jumping around, and you'll do okay. Mm-hmm.
So, David, how does the DXY? You mentioned it just before about it going back up, along with bond yields. What is the driver for the DXY going back up here?
Well, higher yields will do it. Yeah, the correlation between the 10-year and the Dixie is pretty profound. Mm-hmm. When yields go back up, the Dixie follows, because a lot of it is relative interest rates. And as I said earlier, everything goes in zigzags. Mm-hmm. I believe Dixie's going to 98 at least, 94, maybe 92 at worst. Now, but in the meantime, again, you're going to get moves. You'll seldom get a move straight up and straight down. It means it's a parabolic move to the upside or to the downside. They are rarities. I deal with what is the majority of cases. And in the majority of cases, you get zigzags. And if you look at Dixie now, it's down to 101, and it's been beaten down. And I still think it's going lower, but it's to a bounce. But yields have fallen from just over 5% down to 385, give or take, straight down. You think it's going to continue straight down? No. And let's start looking at the RSIs and the MACDs and look at the sentiment. Sentiment in bonds is off the chart. It's bullish. So the same way I look at gold, I look at 10-year. Mm-hmm. So yeah, I see a number of indicators. There's real world circumstances. If you look at the fundamentals too, we can get into treasury bills and 10-year bonds and the interest costs of all the debt that's piling up. That this drop in let's go big picture. This drop in yields is not going to last. Well, I still think we're going lower. The dollar is going lower. But come 2024, perhaps first half, we're going to start to see the collapse of the S&P. We're going to see yields go through the roof. And the dollar is going to have a nice run. But when confidence is lost in the dollar, that's when it goes, it loses its reserve currency status and so forth. So the milkshake guys will get their day in the sun, maybe to 115 to 120, and then see it. Mm-hmm. But in the short term, it's just simply that they've come too far too fast on yields, and they're going to get a correction. And that means higher yields. Mm-hmm. Higher yields, higher Dixie, lower metals. So it provides look, these markets are centrally managed by the central banks and their agencies like BlackRock and so forth. So it's no coincidence that they're all linked. They're centrally managed. They're all linked. So when I look at the markets, I don't just look at gold in isolation. I look at all of them. The correlation between Dixie and the yields broke down recently. It was basically random. I went to more or less zero, but now it's coming back with a vengeance. So sure enough, when Dixie goes up and yields go up, you're going to get gold and silver going down. And that'll be cover for the bullion banks to just hammer it. Mm-hmm. They love that. When Dixie gets a bounce, They're like, foaming at the mouth, ready to go to sell because they say, "Oh, it's the Dixie. We didn't do anything."
Mm-hmm. Once we get that low in gold, you said you're going to be going all in, especially on the high beta miners. So what to you makes a high beta miner in this environment, David?
I did an analysis going back. I don't go back 10 years. People who rely on betas on Yahoo going back 10 years, 5 years, 3 years, it's a complete waste of time. I've said it bluntly because you don't know what drove those betas 3 years ago. It could have been one great earnings call, the thing doubled in price, and the beta looks like, wow, excellent. I look at beta only 15 months back. And because I like a recency bias because I know what's going on, what's driving it. So I went and I looked at, I think it was 160 miners, and I calculated their betas going from trough to peak to trough over the past 15 months. And I found two in particular that are starting to become fallen angels, by the way. They're having a little trouble right now. That stood head and shoulders above the rest. And that was MUX, McEwen, and IAG, IM Gold. And I made, what was it, 200% on those when silver went up 40%. I used silver as my benchmark because surprisingly, GDX and silver are highly correlated. And silver is more volatile than gold. So it was a better benchmark in terms of performance because silver underperforms gold on the downside and outperforms on the upside. So if you've got a high beta to silver, never mind gold, a high beta to silver, this must be a great stock. So I did extremely well with that. So then I delved a little deeper and I found like I have 11 in my portfolio right now that I follow. And what I do is I follow the winners and I scale back when the others start to come off. But they consistently high beta. Both, it's a double-edged sword, I call it. So it goes up, yeah, but when silver goes down, these things get hammered, So you have to get out. When you get to the top, don't get greedy. I call the top in MUX at 10. And I said, get the hell out of this. And that's what happened. Mm-hmm. It was a nice round number. The technicals and all the other things were saying that it was overbought. But when I saw 10, there's a number that the market likes to stop it at. Just like 666 back in 2008. And it went down. But the point being is you can isolate these miners. And people will say, well, you're not focusing on the fundamentals. No, I'm not, because the market knows better than me. The market knows which ones are going up and down. And if these are consistently driving high betas in both directions, the market knows, somebody knows that these are the ones that they've chosen these stocks to play when silver goes up and gold, obviously, and then when it goes down. And I'm just following what the market's telling me. And then when the market tells me, no, this is not doing as well, it's not it's not correlating as well as it was in the past, it's falling back into line with silver, or it's underperforming more so on the downside than it's exceeding on the upside, then I start to scale back on that one, and then I put more capital to the one that's doing better. Like Harmony recently has been a monster. Harmony Gold. That has been the best performer of, and I'm only looking at producers. Mm-hmm. I don't look at lottery tickets, otherwise known as explorers. I have no time for them. If somebody makes a ton of money on them, good for you. I'm not Rick Rule. I'm not Eric Sprott. I'm not going to do the deep dive to figure out who the next lottery winner is. I focus on the producers that are high betas, and it works. Mm-hmm. That's the thing. That's the reason I do it. I started like just experimenting, but it works. Mm-hmm. So I've given that list out who I watch. It does change. There's different miners that move to the top and others that slide down, but the group is pretty much the same right now. And by the way, some of these miners are outperforming silver 4x, 3x. That's silver. Mm-hmm. Think how much they're performing gold. 6x, 8x. I mean, that's why I like silver, because I'm competing against a high beta asset itself, which is silver. Gold is the boring one, but you have to watch gold for analysis, especially when it comes to positioning, because it's the big brother. I mean, it's a tiny market, but it's much bigger than silver, and it's much bigger than any miner. So you have to watch gold, but in terms of calculating beta, I use silver because I'm looking for the biggest gains.
Mm-hmm. Excellent, David. You know, I want to take some time, and I know we're kind of coming up to the end of our time window here today, but I want to take some time and talk a little bit about the great taking. You know, you read it and you wrote a little bit of an article on what David might have missed, as in what you think steps to take are to protect yourself through a possible time like this. So what are some of those steps? Because I know I've gotten a lot of questions from listeners on what actual actionable ideas they should take in order to protect themselves once they understand that book.
I love these kinds of questions because it's a slam dunk. Okay, let's talk about what David Webb said in a nutshell. He basically said that based on his analysis, and you can actually back it up with documentation from the Bank of International Settlements and other agencies, that the law has been changed that you don't have a right to property. You have an entitlement to property. So in the event that a financial institution, be it a bank, be it a broker, be it an insurance provider, if they go bankrupt, which they will in the next year, a lot of them, when it goes through bankruptcy court, the senior creditors get the collateral. Guess what the collateral is? Your property. You don't have any right to it. They will take it first. If anything, you'll get peanuts back. And that's the way the law has been changed, in secret. And they're going to use that to confirm that you'll own nothing and be happy. And how do you address that? Well, the obvious answer is anything that you have in the financial system, now you know that, like gold in a safety deposit box in a bank, if that bank goes bust, you don't get it back. They take it. So what's the answer? You have to keep your wealth outside the banking system. Now, I'm not saying anything novel. This is not news. How do I know? Look what's happening to the banking system. Look at what's happening with the new vehicle that the Fed is using to prop up the banks, the loans to the banks, because they're deeply underwater in terms of their capitalization, because their long bonds there have dropped. What? It's gotten better recently, but at one point they were down 40%. And money is flowing out. The depositors are running for the hills. So this is not news. What they're doing is they're getting the money out of the banking system because they know there's a risk, once some could argue a high risk, that these financial institutions are going to go bust in the next year. And if they do, you are ... I'm not going to say the word I want to use, but it begins with F. And so the only solution that you have that you can take is to follow the herd in that regard. I usually go against it and get your as much as your wealth outside of the banking system, outside of the financial system. And what are the solutions? Well, you could try land, especially farmland, which David Webb mentioned. But the obvious one, and he did say real tangible assets. Well, the paramount real tangible asset is gold. And the next best thing is silver. Now, some will say platinum and palladium. I'm not going to go off on a tangent here. I'll just say they're primarily industrial metals. The gold and silver are monetary metals. And that's why, it's one of the reasons why gold and silver go through the roof. And central banks are vacuuming up gold and silver all over the world. They're record buying. Why? Because they know what's coming. And you should do the same. I've been saying this ever since you and I started talking, Tom, that it's an insurance policy first. It can make you wealthy second.
Mm.
And it's the primary vehicle to protect yourself in the event of a collapse of the financial system, of the institutions where you're holding your wealth today. And I've been saying for a long time, you buy physical gold and silver that you can keep in your hand, not a certificate, not an ETF, physical gold and silver, because they will protect you financially, you and your family, at least financially. And there's no better way to protect your wealth. And I'll leave it at that. I mean, that's the obvious answer.
Mm-hmm. Excellent, David. Well, I know we're coming up against time, and I know I need to get you out of here for the holidays.
Yeah. The boss is giving me the dirty looks. Yeah.
Well, I appreciate your time and your perspective as always, David. It's always a pleasure to get to speak with you. So we can find more of you at your new Substack, FIPESreport.substack.com, 4779capital.com, and of course on Twitter at Global Pro Trader, right?
That's right, Tom. You got it.
And your weekly articles on Sprott Money, as everybody knows.
That's right.
Perfect.
Don't leave it so long next time, Tom.
Well, we'll definitely check in with you sooner then.
Excellent. Thanks
Take
very
care,
much.
David. Thank you.
You too.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.